Let's talk about mezzanine debt. As the name says, mezzanine debt started as an intermediate step between bank lending and equity financing because it contains characteristics of both. But nowadays, it's more of a niche strategy, and it doesn't just contain mezzanine instruments, but possibly others as well. Let's take a look. Let's talk about mezzanine debt. Mezzanine debt is a type of unsecured and subordinated debt that usually charges higher interest rates. And those two characteristics are connected, precisely because there's such a high risk, because the mezzanine lender is the last to be paid in case of default, and they may very well get nothing. They charge much higher interest rates in return. Mezzanine debt is frequently used to both finance corporate needs in terms of operations, but also to sponsor transactions. It's very flexible. The name mezzanine, just like the mezzanine in the home in the picture that I tried to find for the lesson, is supposed to represent an intermediate step. It comes from the fact that historically, mezzanine was an option beyond what the banks were willing to provide, but still less costly than equity financing. Or in other words, a company could either get a bank loan or raise an equity round, and there was no option in the middle. Mezzanine came up as that intermediate option, less restrictive than bank debt, but also less expensive than equity financing. In reality, nowadays, mezzanine financing can include both senior and subordinated components. So the line between what is private lending in general and what is mezzanine in specific has started to blur somewhat. As mentioned, mezzanine debt by nature is subordinated. This means that in the case of bankruptcy or liquidation, mezzanine lenders are repaid after all other lenders. This is usually achieved through something called an intercreditor agreement. So when a mezzanine lender makes a loan, they get in touch with the other creditors of the borrower and they sign a deal with every single one of them that states that their debt will be repaid after them. So the higher interest rates are charged precisely to make up for this higher risk. Think of the business model as the following. They get very high periodic payments, but they are willing to get nothing if there is a default. High risk and high reward. With the advent of new direct lending solutions such as unitranche over the years, and with competition among private lenders, mezzanine lending is becoming more and more of a small niche. There are many other options nowadays, including capital market products with different levels of risk, or structured finance products, and many other combinations that just make mezzanine almost unnecessary. It's just another option. So nowadays, mezzanine has only two major applications. The first is to provide bespoke financing solutions for middle market companies that don't want to or cannot resort to banks. So mezzanine lenders can create very specific tailored financing packages with specific repayment options, including cash or payments in kind, and also tailored based on the specific cash flow, leverage, and other possible factors that are unique to the borrower. The second use is to serve as a substitute for high-yield bonds when the high-yield market is suffering from some kind of irregularity. If you've been paying attention, you know that mezzanine debt, just like junk bonds, shares both a higher risk profile and higher interest rates. This makes them a good substitute for high-yield bonds when these are not available. What are some examples? The first is mezzanine as a niche that is being backed into a corner. Mezzanine started with a significant market share in the past because everything that was not bank debt or equity rounds was done by mezzanine. But with the advent of other products such as unitranche and other flexible financing options, a lot of its market share has been eaten away, and now it's a super specific niche. As we've seen, it can be a powerful substitute for junk bonds. Mezzanine debt shares some similar interest rates and risk levels. They're not as risky and the interest is not as high, but this can be adjusted. So this allows it to replace high-yield bonds when these are not available as a tranche of a bigger financing structure. And finally, it's a common part of leveraged buyout financing. Buyout deals usually have a tranche of senior bank loan, a tranche of junk bonds, and then a mezzanine tranche somewhere in the middle. This is very common. What are our key takeaways here? The first is that historically, mezzanine debt stood between bank debt and equity investments as an intermediate step, less strict than bank debt, but less dilutive than equity investments. Nowadays, it has been reduced to a small niche. Mezzanine debt is usually subordinated and the last to be paid. It charges higher interest rates to make up for this. It's unsecured and the lenders are the last to be repaid. As we mentioned, their business model is the following. Charge high rates to get good periodic returns, but if there's a default, they accept losing that investment. And finally, mezzanine nowadays is either bespoke for companies or a substitute for junk bonds. It's a niche that either serves a fully bespoke financing solution for middle market companies based on specific cash flow and capital structure, or a substitute for high-yield instruments at times when the market is not available or not regular. So as we see, mezzanine debt has been losing market share and nowadays is a niche. It started as this kind of intermediate step between bank debt and equity investing. But nowadays, it's only used for very specific financing needs or as a replacement for junk bonds due to their similarities.